Welcome to Module 1, Lesson 2 of the ForexDelight Trading Mastery course. In this video, we will be covering currency pairs, pips, and lots. In Forex, currencies are always traded in pairs. When you trade, you simultaneously buy one currency and sell another. For example, in EUR/USD, the ratio of €1 to US dollars is shown. A currency pair consists of a base currency and a quote currency. The base currency is the one you are buying or selling, like the euro in EUR/USD. The quote currency is the price of one unit of the base currency, like the USD in the same example. Currency pairs are categorized into three main types. Major pairs are the most liquid with the lowest spreads. Minor pairs do not include the USD, offering moderate liquidity. Exotic pairs have higher spreads and are more volatile. A pip, or percentage in point, is the smallest price movement in Forex, usually the fourth decimal place. For instance, a move from 1.0850 to 1.0851 in EUR/USD is 1 pip. Japanese yen pairs use the second decimal place. A lot is the standardized transaction size in Forex. Standard lots are 100,000 units, while mini lots are 10,000 units, and micro lots are 1,000 units. Mini lots are best for beginners. Calculating pip value is crucial as it determines your potential profit or loss. For example, if you buy 0.1 lot of EUR/USD, each pip movement is valued at $1. Your position size determines your risk. It is recommended to never risk more than 1 to 2% of your account per trade. Carefully calculate your position size using your maximum risk and stop loss before entering any trade. To summarize, currency pairs are based over, quote, a pip is the smallest movement, and lots are transaction sizes. Always calculate your risk before trading. Join us for Lesson 3 on technical and fundamental analysis.